So as long as it's fair, as long as it's voluntary, inequality is fine. Inequality is great. We want those who succeed to be more rewarded than those who destroy value. But in the sense of our current environment, we have really sinister inequality.
If everybody, if the water's flowing and everyone is benefiting, right? Everyone's cup is filled. People are happy, right? They have better things to do than to line up outside of someone's house and threaten to chop their head off.
I don't think we should be setting up guillotines anywhere, and that's why I love Bitcoin. It's the peaceful revolution, right? But why do people want to set up these guillotines? Because they know the system isn't working. It's not working for them, and despite working very hard at many jobs and climbing the ladders, it's still the prospects for retirement, even the ability to afford a home today is just it's outside of the reach of so many very hardworking Americans. The system is not serving them. The system stratifies wealth through asset inflation and in disproportionate access to assets.
Welcome to the Tucson Blockchain Podcast. Today I have on Greg Crennan from Golden Coast Consultants. Greg is a financial advisor and a gold bug. I ran across him on Twitter and I thought I had to have him on the podcast because he, like myself, understands that inflation is terrible and dislikes the Fed. He says that his job is to protect people's wealth from out-of-control central bankers, and this was a great conversation as we discussed that. Alrighty. Welcome to the podcast, Greg.
Hey, thanks, Alex, for having me.
Yeah, tuning in from San Diego. So you're you're a financial advisor at Gold Coast Financial Group. Is that correct?
Golden Coast Consultants, correct.
Oh, yeah, I was off.
That's
And so you manage people's wealth. We had a conversation about a week ago. You manage people's wealth, and you're a big fan of gold in your clients' portfolios, which is kind of a unique way to go about things. A lot of people have gold in their portfolios, but I think you are a bigger gold bug than most financial advisors. So,
I'm for what the mission for Golden Coast is: wealth creation and wealth preservation for anybody, right? So it's how does someone who really doesn't have a lot, build that wealth, and then when someone does have wealth, who retire and doesn't really understand what to do with their money, kind of breaking from the traditional norm of, say, like, having your money managed at Fidelity or other kind of wealth management firms that kind of, force everyone into index ETFs, these Vanguard funds, because it's kind of like a one big scheme, because the funds are run by the companies that are pushing them on to customers. So, they get basically like a 2% fee, and then they collect a commission on the profits that you make. So, you make 10% on the year on your money. Then they take 2% for the fee. They take 2% for commission, and then you have to pay capital gains tax. So, at the end of the day, that 10% that you made for the year is, below 5%. And then you have inflation that could really be higher than 5%. So, you could really have like a zero net gain sum, after all the fees and everything else is done. And then there's a lot of talk about how, like, you have this big passive investing. Everyone just buys the ETFs, buy like the S&P 500 ETF, the SPY, or the NASDAQ, which is the triple Qs. So you have like all this index fund passive investing going into all these funds. And then that's because people who manage the funds, collect a small fee. So they kind of like, distort the, what people should really be doing. And it kind of creates this big, massive financial possible bubble, because everyone's buying the same thing and don't really understand what they're buying.
Yeah. And that's one of the reasons why I feel like the role of a financial advisor is so important, because the typical person doesn't have the time to get in and work on all of these financial tools. And most people, they get a job and start making some money, and they don't know the difference between a mutual fund and an ETF, and struggle with the research. But yeah, the fees
Well,
are.
the
Oh, good.
the other thing too is that companies give you a 401k, and
Mhm.
a lot of times a 401k also forces you into these type of index funds. So basically, the entire system is like designed to force people into the same investment, right? So if everyone's buying the same thing, everything goes up, right? Because there's more buyers than sellers. So all those 401k contributions every month is going into probably some sort of index fund that's tied somewhat to the market. So you just always are going to have like this money flow every single month because if everyone's tied to a 401k until the 401k kind of like goes away, basically.
Yeah. Yeah, I mean, there's one of the growing trend. It's been a trend for a while, but one of the growing trends is just seeing older people working because they're unable to retire, even if they've had savings throughout their whole life. And inflation's really that killer. One of my favorite tools to point people to is the Chapwood Index, because Ed Butowski takes a basket of like 500 goods per city and is able to calculate the increased cost of living. And so in San Diego, it's probably a lot more than, I would imagine it's a lot more than Tucson. Tucson's one of the lowest in the country, but it's still an 8.2% yearly increase. And that's pretty hard to beat. Oh.
Yeah, no. As far as the inflation and kind of like looking at the cities, I like to look at on the Fed. They have on their Fred website or Fred app. You can pull up the U.S. top 20 consumer price index. So obviously, most people live near or in cities.
Mhm.
So it gives you a better price gauge on what inflation. That number is pretty high. I think the last time I checked, it's around like 6%. So like, the top 20 cities, inflation has gone up 6% year over year. So, and that's the majority of where people live is near cities. So that means majority of the populations in the U.S. is being affected by inflation. But those things that they're considering that it's like, say, up 6% year over year is like food, shelter, which aren't typically measured in what the Fed measures in inflation. So, and then things like minimum wage, minimum wage is going up in all states. So even though the federal law minimum wage right now is only like $7.50, each state can put their own law or pass their own law for minimum wage. So like each state, I think 20 something states have been raising their minimum wage above the $7. So that passes a cost amongst goods and services to the consumer. So you have like all these factors coming into when it comes to inflation, and also the fact that inflation is not really defined perfectly. So a lot of people talk inflation and deflation, and you can say, well, if you're going to have deflation, well, how can that be possible if minimum wage keeps going up? So Joe Biden's running for president. He wants to have a $15 minimum wage. So you can't run a business operating as if you were paying people a lower wage. That means prices have to rise. So people say, well, we would have deflation in the future. How could you, if you're paying people more money, unless you're selling way more? But then if there's, so there's that whole supply and demand imbalance, but there's a lot of factors that go into it. And you have also like, they're doing new monetary policies, such as the additional unemployment benefits. They're doing the, just $1,200 stimulus checks, just giving people money. Trump announced over the past week that he just wants to give out $1,200 checks to everybody. So like you have this massive increase in basically purchasing power, where more people will have more zeros in their account, but then that there's no more actual goods that you can purchase. So that stays fixed. So those prices would have to rise to kind of balance the equilibrium between the supply and demand for goods and people that want them.
Yeah. So pretty much what we're going to see is the dollar menu at McDonald's going to grow ever more small and even cease to. It's going to be
that 99-cent menu. They it used to be like 6-piece chicken nugget for 99 cents. Then it became like the 5-piece chicken nugget for like 99 cents. Then like the 4-piece chicken nugget. So there's other ways that you can have inflation, right? So you can be like, well, the chicken McNugget thing is still 99 cents, but you used to be able to get like 8 chicken nuggets for 99 cents. And so the amount of quality is getting less and less chicken nuggets, but the price is still 99 cents. So that's still inflation, even though people are like, oh, it's still like the dollar menu item. So there are multiple different ways that the entire system manipulates around inflation. But when you go into the root cause of these prices and how like even the chicken nuggets that are getting lower and lower in that 99 cents is because the dollar is losing that purchasing power. So the dollar used to be able to buy you, say 8 chicken nuggets, years ago. Well, now it only gets you like, whatever it is, 5-piece, 4-piece, chicken nuggets. So, I can buy less chicken nuggets now with $1 than I used to be able to at McDonald's. So all of this, is the root cause of the devaluation of the dollar. And they have all these, CPI and a PCE inflation gauge, and they changed the definition of inflation is because they don't want people to really understand what inflation is, which is basically the devaluation of the dollar causing the price of goods to go up. And when you're looking at, when you do a science project and you are trying to, you have a hypothesis, you're trying to figure out like, well, what if I change this, right? You have to always have a constant, right? So if I am trying to figure out if there's really inflation, I would need to have like a constant over a long period of time. Well, over a long period of time, the best gauge that we have would be gold, right? So gold, and you can just go back, the 107 years that the Federal Reserve has been created. And gold used to be like $19. Well, now it's like 1,900. So that means that the dollar has lost 99% of its purchasing power over the past 107 years. Because what we know is that gold, 1 ounce of gold used to be $19. Well, now it's 1,900. So over the past 100 years, 1 ounce gold hasn't changed, right? So if you had 1 ounce of gold, and if our great grandparents had 1 ounce of gold and they all kept it, it's still 1 ounce today, and it's still gold, and the values and the properties are still the same, but the value of the dollar has decreased by 99%. So that would be our constant. So when they're talking about all these different inflation measures, and the CPI and the PCE, and they're now we're targeting 2% inflation or higher than 2% inflation. Well, what's the constant? Because they also keep on changing how they measure inflation. So if they keep on changing it, it just keeps everyone in like this guessing game, because they don't want people to actually know, because they're the ones controlling the money supply. So they come up with these different things, different formulas, different terms to kind of keep people off their toes. But so you would need a constant to really understand, well, is it inflation or deflation that we're having? And the only good constant that we've had over the past 100 years, 100 plus years, gold has been around for thousands of years, but if you want to talk US specifically, a good, 100-year history of inflation would be the price of gold.
Yeah, one of the things I like to do when I'm explaining inflation to people is start to price things in gold, like price the S&P in gold or price the dollar in gold. Because generally we price everything in the dollar, and when you do that, it gives you a very different picture of inflation. That the S&P isn't just going up at a 45-degree angle constantly, but the dollar is devaluing as well. So it's not as dramatic as people think.
Well, one of the things also for like inflation, right? So, 100 years ago, people used to be able to buy a good tailored, our culture has changed a lot, but 100 years ago, you used to be able to get a good tailored suit for 1 ounce of gold, which was like $20. Well, going back to like that constant, if you were to get a nice tailored suit would probably run you about 1 ounce of gold still, which would be about $2,000. So when you say like, well, one of the reasons why we don't buy a lot of suits is because one, it's expensive. I think a lot of people would probably like buying and wearing nice suits, but people don't want to fork over $2,000 for one. But we used to be able to do it. If you look at pictures from like, the 1920s and the 1930s and the 40s, like everyone used to wear like 3-piece suits, like everyone, right? So it didn't matter. So how did like everyone be able to afford a suit back then? And then like if we try to do that today, people would probably be like, we can't afford like, that many suits. So that goes back to like kind of like that constant. But, gold is basically kind of, one suit has kind of kept up with like 1 ounce of gold throughout that history. And now there's other things that take place that cause the price of those suits to go up, with like the cost of labor, the cost of materials. But that's all because the dollar has been losing its value. So all those other things get more expensive. So therefore the suit becomes more expensive.
Mm-hmm.
So that's just kind of just another example.
That's a really good picture. And a lot of people my age are finding it's really getting out of school with tons of student debt. I was just talking to my friend. He's in a PA program. So he's going to make a good chunk of money straight out of school. But he's leaving. A lot of his classmates are leaving with 6 figures of debt. And so, and then to go and buy a house on top of that it's just quite a huge burden. And the wages don't follow the inflation. And it's a big reason why we see such a stratification of wealth in our society, is because what I hope when people hear inflation is they hear confiscation, because that's essentially what the Fed is doing, is they're confiscating the value of our wealth and redistributing it to the people at the top, to the so yeah. So what got you kind of on anti-Fed bent?
It was really just understanding the system. It started in 2008 when we had the financial crisis, and really kind of like learning the system and learning why things happen. So that was one of the reasons where it kind of got where I was able to get to where I am today. Really just understanding the system, understanding monetary policy, understanding what they were doing with quantitative easing, lowering interest rates to 0, which, is, and for so long, which was, unheard of at the time. Now it's like standard operating procedure, right? So they said, rates are going to stay at 0 until 2024. So like, okay, great. So, you're not even going to consider, if consumer prices do rise. So, really just understanding like what they're trying to do so that I can help people protect themselves. And because, I think that's part of the issue too, is people don't understand how to protect themselves. Mm-hmm. And the other thing is, and like I said, a lot of people don't understand. Well, they can say, well, inflation is also like great if you own financial assets like real estate, stocks, and other assets, but you're forgetting that the reason why they want inflation, and this is one of the reasons why they're like, we're going to inflate our way out of debt, or you may have heard that expression, we're going to inflate our way out of debt, because if I sell my home for a higher price than I bought it, there's a capital gains tax on that. So the government's now going to get a piece of the value of the house going up. And then not only that, but every single state, if housing goes up and you sell your home at a higher price than you previously did, the house gets reevaluated on a higher property tax. So if I had a house that was at $500,000 and I was getting 1% on that, which is $5,000 a year, and the value goes up to $600,000, now the property tax will go from $5,000 a year to $6,000 a year. So now that's more state property tax will collect based on the sale of the home going up. So they want real estate and housing prices to go up, because that means now property taxes have just gone up. And the city or states don't actually have to increase the property tax, right? It could always stay at 1%. But if housing keeps going up and up and up, that 1% gets larger and larger and larger. So now that's more money that the state is taking. So that's like that. That's why they say inflation is a hidden tax, and one that many people don't understand.
Yeah. I mean, there's so many taxes out there that are just,
oh yeah, right.
Unbelievable.
But that inflation, that tax is like, so people, that property tax is a huge one, because people don't realize, states never have to raise the property tax. They just need the housing value to go up. And what does lower interest rates do? It makes the price of housing go up, because you can now afford a higher monthly mortgage payment. So instead of affording that $500,000 house, you can now afford that $600,000 house.
Yep. Why do you think there's such a mainstream consensus that inflation is good for economies?
Well, exactly why to protect the extremely wealthy, because they own assets and they don't want to be in the dollar. So they, the lesser or the more that the dollar loses its purchasing power, the wealthier that they become without actually doing any work. So it's like, it's easy. It's like saying, like the housing example is just a great one because everyone can relate to housing. It's like everyone thinks that they're getting rich if they own a house, but it's really the dollar just losing value. So you didn't really do any extra work. You just bought a house, right? But the house is now 10% worth more than what you bought it at. And that was because, of everything we just recently talked about was, interest rates went down. More people can afford that monthly payment. Maybe they put less money down than say 20%. They put 15 or 10% down. But everyone thinks they're getting rich because they say, "Oh, I bought the house for 500. Now it's worth 600. I gained $100,000." But in reality is, well, then where else are you going to go? Because everything else went up by that 10%, right? So once again, it's a zero net gain, but people think that they're getting wealthier because they see the numbers getting up. So it's a nice little trick in society where, we can kind of, and it's kind of like call it a wealth effect. Have you heard of that before?
No.
All right. So the wealth effect is basically like if they own money in the stock market, and if they own a house and they have their housing value goes up, which, housing is now the most expensive it's ever been. The stock market's is the highest. It closed, near record highs today. So everything, if you have any of these financial assets, they're the highest in history. So you may not actually take out money on your house or out of stocks, but you may spend more money because you're like, oh, well, my house, I have $100,000 in value in my house that I can always refinance in the future if I want to get that equity out. So you go and you spend, you get a new car, new TV, and that's kind of like what caused the housing bubble, is that people thought they were so rich on paper because housing values kept on going up, and then they kept doubling down until it just couldn't anymore. So that's the wealth effect, is that you feel richer than you really are because your asset is going up in value, and that's what inflation is. So, and Jerome Powell recently at his last meeting said that, yeah, if you own financial assets and we're targeting inflation over 2%, it's going to benefit you.
Yeah.
So those who don't own financial assets are going to get left behind, and then you have that wealth inequality widen and widen and widen because those who don't have those financial assets get wider and wider and wider.
Yeah, it's pretty astonishing when you look at the numbers as far as who controls the majority of these financial assets, and how centralized the wealth really is in our society. Because the majority, the stock market going up doesn't affect the majority of Americans, but the purchasing power of the dollar does. And so, yeah, it's pretty wild to see the president tweeting about it and proclaiming how great it is that the S&P is going up when you have record unemployment and an eviction crisis. Yeah, that was something I talked a lot with your friend Fed Up Biz Owner on the podcast, was the looming eviction crisis. So for somebody that's just starting off and doesn't have any wealth, what are some good tools for them?
Well, the number one thing is eliminate debt as quickly as possible, right? So if you have a credit card debt, and what people don't realize is your credit card interest rates are still like around like 20%, even though the banks are getting, zero interest rate from Fed. So, these banks are charging people up to 20% on interest on their credit cards. And so basically they're lending to you, say $10,000, and then you max out that $10,000 on the credit card. And they know that the dollars are losing value, but they're getting back 20%. So it's a huge win for the banks, while people who need money max out their credit cards and then eventually don't have enough money to pay them off, are stuck paying this interest rate. And then every month it goes higher and higher, and they think that if they're just making the minimum payments, they're doing okay, which in reality they're not. So, eliminating all debt. Now things like a house, if you can be in a good and own a house, not saying like a super expensive house, but just a house in general, because of the low interest rates and inflation, that basically you can borrow money so cheap to purchase a home. And if we believe that the dollar is going to continue losing its purchasing power, you're basically going to pay the bank back that's lending to you cheaper dollars than what we're purchasing today. So that kind of could be a great trade or investment going forward if you believe that we're going to have bad inflation over the next decade or so, or longer. And yeah, just eliminating the debt, and then when you have currency, dollars, and you're debt free, is finding assets that will, if you buy a business or a stock, you want something that pays you to own it, or you want an asset that does well with inflation, or an asset that is in high demand where the value of it will go up because supply is limited. So it's kind of like looking at all these macro economic themes, and then figuring out, and then each person is different, and then figuring out where is my best return on investment. And that's kind of like what's driven the stock market up so high, is because when the Fed went to zero interest rates in March, people are like, okay, great, I have all this cash that yields me nothing, I got to put it somewhere. So where do they put it? They put it in the stock market. But the thing is, gold and silver have actually outperformed the S&P 500 and the NASDAQ this year. So gold has outperformed the S&P 500. Gold, I think, and don't know exact, but it's like gold's up 27-ish% year to date. S&P 500's up 5% year to date, 4% year to date. So gold's outperformed the S&P 500. Even if you threw in the dividends that you would get through the S&P 500, gold's still outperforming the S&P. Now the NASDAQ is up, I think, 30-ish%. So it's outperformed gold. But then if you look at silver's outperformed the NASDAQ. So year to date, silver's up over 40%, and the NASDAQ's up like 30, 32%. So gold's outperforming the S&P, and because the S&P is considered, because it's the 500 best companies in the world, so it's kind of the gold standard. It's funny, gold standard companies is, comparable to gold. And then you kind of have the NASDAQ, where you have all these companies that really aren't that profitable yet, but you're paying up for potential growth and potential profitability in the future if you believe in them. So that's kind of like silver also. So silver has those wild swings. So gold and the S&P 500 sometimes tend to limit some of that volatility, while in the NASDAQ, you can have more of those upside swings to the upside and also to the downside. But yeah, silver has outperformed the NASDAQ year to date so far. So that, that's just kind of showing you that precious metals, if you want to look at inflation, really may not actually be in the stock market. It could be in precious metals.
Yeah. Yeah, I'm looking at the price of silver right now. Yeah, gold is... Oh, go ahead.
No, I think silver closed over or near 25 today, I think.
Yep.
$25 an ounce. But which was funny, because the U.S. Mint by the government is saying that 1 ounce silver is actually now going to be valued at $67 an ounce. So there's actually a huge difference between what the U.S. Mint is offering a 1 ounce mint coin versus what 1 ounce is selling for silver's futures contract. So what I guess I'm trying to say with that is that the U.S. government is saying that silver is really worth $67 an ounce, but the market is trading it at 25. So that means that the U.S. Mint would not accept $25 for that silver. Well, so that is another, inflation gauge, one of those constants. You could look at silver along with gold as one of those constant over a long period of time if there is inflation or not inflation. So you can kind of maybe, compare both of them to really find out. Because you want that long history of data to be like, well, do we have inflation or don't we have inflation? Because, like I said, they just keep on changing the definition and the different way that they measure it. And they do that on purpose so that it messes up everyone's investment strategy. And then, we get programmed to think that we don't have it. We've never had inflation since the 70s, basically. And people keep saying that we haven't had inflation since the 70s. And I think that's all part of the grand scheme of once we went off the gold standard and we had that inflation, and once they raised the interest rates to 20%, it was basically cutting interest rates all the way down to where they are today at zero since the 1980s. And what has that done? Well, it's made housing go to all-time highs. It's made the stock market go to all-time highs. It's made the bond market go to all-time highs, and it's made precious metals go to all-time highs. So literally, all four of those assets, if you owned them and just held, allocation in your portfolio of each one of those four assets, are all worth more today than they are in the 1980s. But then you take into consideration, it's not really that they may be actually worth more. It's just that once again, going back, that the dollar lost its purchasing power since the 1980s.
Yeah. Yeah, and I think that's a realization. You talked earlier about 2008 being a real catalyst for you to start learning about this stuff, because it was just, I think for a lot of people, it was the first time that how crazy and nefarious the actions of bankers in general have been. And it really started devastating communities just very openly and blatantly. And I think we're seeing.
I know out in Arizona was really bad during that time for real estate.
Yeah.
I don't know if Arizona really recovered 100% from that time frame.
Yeah, I'm not really sure either. I mean, one thing that I know is that, Tucson specifically, wealth inequality is a major issue. And when I talk about wealth inequality, I don't believe in, socialized taxing the rich and redistributing the wealth, because what's inevitably going to happen is the government's going to, do a really poor job of it. And what we're in our current monetary system, like going back again, just reiterating, we're seeing a taxation and confiscation of wealth from people in the middle and the bottom and redistributing it to the top. And that's really problematic. So that's the type of wealth inequality that I focus on and talk about, because what I want to see is a system that is fair. For anybody that says that inflation hasn't happened since 1971, that's a really crazy statement. There's these guys.
Or the 80s, or at least the 80s,
Yeah.
at least the 80s.
Yeah. Yeah, I get really.
So the past 40 years, basically, people have said that we haven't had inflation since over the past 40 years.
Yeah, I mean, you can ask any average person, have prices risen over the past 10 years and have your wages followed, and they'll all say no, unless, they were getting, sweet job offers or promotions or something like that. But it's pretty, we feel it's a slow increase, but it's a consistent one. And
well, there's a lot of factors that go into, there are, because it is supply and demand, right? Because, if they create all this new money, but if it, like right now, they're talking about, almost $2 trillion in a legislation bill. It depends on where that money is going. So if it's going directly to the people to spend, but we're not making any more goods, well, then the price of goods would have to rise. So, but if they're printing it and it's going to say businesses like the airlines, well, no one's really flying. So they're just giving money to the airlines to stay in business to pay their debt that they have. So that's not really inflationary, even though they say, say they came out and they said, we're going to do $500 billion and go to the airlines. Well, the airlines, it's just for them to just, keep flying basically and not to lay off the employers, which I mean is a little bit in a way but they are still contributing. Like they're not really spending their money directly because they're still working, even though no one's using their goods and services. So it's like, keeping up this, zombie of a company, because they're not really helping the current economy right now. So, but yeah, so like I said, there's just different ways. So it depends on where the money is going, because they can create all this money, but if it's not out in the economy, so that there is that effect where you need velocity. But I think that the velocity is also misreported a little bit, because, if you look at the M2 velocity chart right now, you would see it on a huge decline downward. But what I think what has happened since the first CARES Act was that a lot of the money that people got, they paid down their credit card debt, they paid down debt, and they also put money in savings. So you actually have like this cash sitting on the sidelines right now. So there is a little bit of this velocity going downwards. But then you would also look at the housing market, and you can see that people are buying houses and moving at a pretty significant rate. So that means that new loans have to be created to purchase the new home. So the money doesn't necessarily have to be like, I give it to you, Alex, and you give it to me. But like, buying a home and then creating that loan. And then obviously things like Depot has done well and Lowe's has done well because then people are buying these homes, and if they have equity on the houses and they're maybe going to a new home or a bigger home or downsizing, but they want to fix things, they then take this equity that they had from their previous home and they're spending it and doing upgrades for home improvements. So that, that's why if you look at those two companies, they're actually doing quite well since, the CARES Act was passed. And the Fed went to rates with zero. So, and that's kind of how the lower interest rates kind of would help the actual economy. But since there's just so many unemployed Americans right now, it's very hard to get to those, 15 million Americans, especially when we're all working remotely, kind of like what we're doing right now on this, podcast. And where, maybe we used to, people used to have studios, right? And we'd be in a studio room right now, and then I would want to, do a happy hour with you afterwards. So then we go out to a local restaurant, and then we have, spend a couple $100s at a happy hour, or, and then I'm in a city and then grab, lunch and help that small business, grab like a $10 sandwich. So like all those small businesses in like the big cities like San Fran and New York, especially in like New York, where, you have all these small businesses, like all those pizzeria shops, right? So if there's no more people working in Manhattan that, and which there are, I forgot what the actual numbers are, but it's pretty bad. All those like small business pizzeria shops in New York and Manhattan, they're losing out on business because where's that lunch crowd? Where's that late dinner rush, right? Because you don't have that guy leaving the office at 7 o'clock on a Wednesday who, missed dinner at home, who has to pick a slice up at the parlor on his way to the train station. So like all of that business and all that, spending in the economy has now, taken a nosedive. But then things like, well, Home Depot is doing really well because people are buying houses, moving to the suburbs and remodeling homes. So Home Depot is doing really well. And we're leaving these small businesses behind for the economy. So there's a lot of factors into it. I mean, that's just natural. But I mean, natural because of the way that the government reacted in shutting down the economy with coronavirus. It may be a little bit different if we never went to that length of shutting down everything. But yeah, I mean, because of what has happened, has affected a lot of small businesses, especially in cities. Like, all that, I'll use New York because, people can kind of get the idea. Is like everyone used to go into the city and get that cup of coffee going, and there used to be a coffee shop, right? So if there's no one going into the office anymore, all those small businesses that were selling coffee, because they got a small little spot in San Fran or New York or, LA or Phoenix, that they were hoping to make money selling coffee in the morning. Well, if none of that foot traffic is there anymore, all those businesses then go out of business. And that's what happens during, downtrends in a business cycle. But then, like I go back to the big companies, well then, Apple then of course benefits from everyone working remotely and needing new electronic devices. So their business goes up, while all these small businesses of America take a huge hit.
Yeah, the business cycle is a really, I think, good way to look at things. So typically what would happen in a business cycle if there wasn't so much central planning over the economy is, these companies like the airlines wouldn't have been doing things like billion-dollar stock buybacks, and they might have cash on hand to deal with the situation. Then bad companies would go out of business. But what our entire economy, or at least the bigger firms that are closer to the politicians, are incentivized to do is to, operate with way too much debt and then get bailed out if anything happens.
Well, if you look at debt to GDP, it's now at like 136%.
Mhm.
So one of the reasons why, and it's not just the U.S. It's so I don't want to make it seem like the U.S. is the only one that's like it. It's all countries. But because we live in the U.S., so everyone who's tracking is on the same page. So the debt to GDP is 136 right now, meaning that the government is spending more money and giving it out than we are producing goods. So the only way that the GDP numbers can grow is if the government basically continues to dole out money for the GDP to grow. And it's been over 100% for, I forgot how long, but it's been a while though. So it's not like it just happened when coronavirus happened. It just accelerated. I think it went from like before coronavirus, it was like 120-ish, maybe a little bit lower, 120. And then after coronavirus, it shot to like 136. So the amount of debt that we were taking on to get the GDP numbers, right? So they were describing that this year we ended the longest economic expansion in U.S. history. Well, it wasn't really an economic expansion. It was just a debt expansion. So all the debt that we accumulated as a society, we just took on more money from the future to purchase goods today, like maxing out those credit cards, and then buying goods today, which kept the GDP high. And when you do that, that means that you have to suffer in the future if you buy something today, because that means you won't have any money because you got to pay off your credit card. So now they realize with everything going on with coronavirus, and that's why these stimulus talks, like the Democrats wanted originally like 3.4 trillion, then it got down to like 2.4. The Republicans were like at 1 trillion, and it's like now we're just talking trillions. Like, and we just did 3 trillion in March, and 7 months later we're talking like another 3 trillion. So that means like going forward, the government's going to have to print like $6 trillion out of nothing for the foreseeable future, because everyone's tapped on debt. So you and I could be tapped on debt, and that means that our future spending is going to be limited. So that means the GDP in the future won't grow, and then that's when you can have, which I believe that we're in right now, is stagnation, where you don't actually have economic growth because we're not actually making more things, but you have more money and the prices of goods go higher, and then you have higher unemployment, which is around, truly around, I think it was reported around 8% on the last jobs report, but I think unemployment for Americans is really around 15%. And I think because of the work remotely movement, you're not going to have, because a lot of those people who are unemployed are the people we talked about, like those small business owners that, are not going back anytime soon. So, you're going to have unemployment lasts longer, prices rising, and then no economic growth. So that's stagflation in my book. But if we weren't having the massive amounts of stimulus that the government is doing, we would be in an actual compression. But because of what they're doing, it's helped maintaining those artificially high prices, and that's why we're in stagflation.
Yeah. I think, when we're looking at the economy right now, it's really important to have a bigger time perspective, instead of just seeing that, like, the issues we have are because the Democrat shutdowns or because of Trump's tax cuts or, whatever is being thrown out there, that this has been decades in the making. If we weren't so over leveraged as a society, it'd probably be easier to bounce back.
Well, it's not good politics. So, especially when you're running up for a re-election. And when you're running for a re-election, if the economy is not doing well, your chances of, we'll find out how this one goes in 21 days. But usually, if the economy is in a recession, no president has won re-election dating back to Hoover, I believe. So Hoover was the first president, and then we'd had Hoover, we had Carter, and then we had Bush Sr., and then Trump would be the next president so we'll see if it's different this time. But yeah, no president has won a re-election during a recession. So it'll be interesting, or at least over the past 100 years or so. So it'll be interesting to see if, how that plays out.
Yeah. I think we're all dreading November together. So yeah,
You go. Sorry.
so the system is really just broken, and I think that people are waking up to it. How do we exit this system?
Oh, well, my opinion, there's a couple of different ways. There's one, the honest way, which would mean that you would have to cut government programs, and you'd have to have interest rates rise and not have the Fed keep them at zero, which would be extremely painful for the economy. But that would be the honest way. So basically, letting the market function and let things play on its own, the laissez-faire way, as you would say, which is political suicide, because that's the other issue, is that when we have these type of crises, it makes it seem like that the government's responsible for solving the problem, because they want to get reelected, right? So, and I'm not saying which side is right or wrong. I'm just saying how they play. It doesn't matter who you are on what side, because they want your vote to say that I will fix it. Vote for me, and I will fix the problem. But the problem's been ongoing, for a very long time, and then they just exacerbate the solution or their solution every single time, because it's the same thing over and over and over again. So the only real way would be to just let everything kind of like function, and let people make their own decisions and not have the government involvement. And now everything's a crisis. You have the student loan crisis. Well, how did the student loan crisis become a crisis? Well, the politicians, on both sides, Republican and Democrats, said, well, everyone should be able to go to college, so we'll back government, we'll back student loans for everybody. Well, why should like an 18-year-old be approved for like $50,000 or $60,000 loan with no savings and no history of paying back a loan, right? The whole point of a loan and having a credit is knowing that when the bank gives you money, that they're going to get paid back. Well, banks never were lending a lot of money to kids, so the cost of education were low, until the government said, well, if the student defaults, we'll back the loan because we want to make it sure that kids go to college. So after the prices started increasing, and they just kept on getting backed, which means that they're backed by the taxpayer. So me and you are on the hook for people defaulting on their student loans. And that's just one example on how they thought not enough people were going to college, so the government decided that we'll back all the loans, and that's how now we're where we're at today. So they created their own problem, basically. Instead of like, well, if you want to go to college, you have to get a job and you have to work and go to school. And that's how we used to do it before they approved and backed government loans, was that you either worked and paid your way through school, or if your parents were wealthy enough, they would help pay for school. That's how it used to be. So and it worked, but now they want everyone to go to school. But then if everyone goes to school, it messes up supply and demand, because now if everyone has a bachelor's degree is now just like a high school diploma. So then everyone needs to go now back to school to get a master's degree. And now you need to have a master's degree to be more significantly better than someone with a bachelor's degree. But then if everyone gets a master's degree, well, then now I need to get a PhD. So it's like this ongoing scheme of, well, I need to be better than the person before me. And because the government keeps on approving all these loans, I can keep on going to school and taking on more debt and more debt and more debt, and getting more degrees and more degrees. But then if everyone starts doing that, all of the degrees start to become worthless and worthless, because then everyone has them. So it throws off the entire supply equation of the demand market side of what people should be going into the labor field.
Yeah, I think one of the really unfortunate things happening is so many people going into school don't know how worthless certain bachelor's degrees are. You get a bachelor's degree in psychology or sociology, and you can't do anything with it. You can get an entry-level job, but...
And I know a lot of people who will get a bachelor's degree, but then they want to become teachers, but since they got a bachelor's degree not in education, then they have to go back to the master's program to be able to become a teacher. Mm-hmm. So, you take on more debt, and, it's just, it's definitely a mess. But the whole point is that government got involved in the market and why? Because they were trying to get people's votes and get the younger demographics to vote for them by saying we're going to make college affordable for people. And by doing so, it now turned into a student debt crisis.
Yeah, and it became even more unaffordable.
So now the vote is, well, vote for me and we're going to cancel student loan debt. Well, who's going to cancel student loan debt? That means that the Fed would just pay for it and the American taxpayer is on the hook for it. But is there a way of now getting your vote for solving that crisis that they created? And it goes on both sides. Like Trump created the trade war, and then he solved the trade war with a trade deal signing. So we didn't have a trade war before Trump happened. And then we had a trade war, and then he got the trade deal. So we had no problem. He created the problem. Then he solved the problem. Then he gloats about how he solved his own problem that he created. So once again, government getting involved in the markets just so that they can say that they're the heroes, basically. And then that's how you get your votes through our system.
Yeah. And they love to use tariffs and things like that to protect the government monopoly or created monopolies. I've been reading this book that was suggested to me on the history of the Federal Reserve called The Creature from Jekyll Island. And it's been a really good read. When you were talking, one of the things that came to mind was the idea of the FDIC being a scam. And essentially, when you go into the bank, you see a placard or something that says FDIC insured, and people look at that and think that that means that they should be more comfortable with their money in the bank, because if the bank is insolvent, which they all are, or on the verge of being, it means that the government will back up, the money they have. But what people don't think of is what that really means is it gives the banks free rein to dish out all these loans that are subprime. And then we bail them out with our money, which is pretty wild. It just came to mind when you were talking.
Well, that's it. Yeah, that's just one of the things that are an issue with today. But someone asked me, well, we shouldn't be bailing out the airlines. We should be bailing out, like we said, like that small business owner who runs that pizza shop, and the coffee shop that employs people and gives coffee every morning. But I'm not for bailouts in general, but the argument was like, how are we bailing out and giving all this money for the airlines, and maybe the small business guys don't need as much money, we can help them out. And my answer is like, well, how much is average Joe or Jane donating to Trump or Pelosi's PAC contribution, versus the airlines are saying, here's a check for X many millions of dollars to get the stimulus approved, where Pizzeria Joe and Coffee Jane can't do that for Trump or Pelosi. So a lot of the talks is like, well, we'll just get the bailout for the airlines and focus on everything else later. So once again, it's kind of screwing over that small business owner versus say the airlines, the unfairness. And that's one of my big things. If you follow me on social media, is I advocate for is that government should not get involved, because it picks these winners and losers. So a lot of people are upset that they're even talking about another bailout for the airlines when all these other small businesses are going to get canned. And I said, well, that's what happens when government gets involved. They decide who wins and they decide who loses, instead of a true free market system. Well, if mom and pop are going to fail at the pizzeria and the coffee shop, well, so do the airlines. And that's capitalism. It sucks, but at least it's fair that the airlines are going to have a hard time, and so does mom and pop running the local stores. And then you let, maybe everyone has to come together and create a new business. But by then the government coming in and saying airlines are good and mom and pop are bad, it disrupts the entire free market system. So, I don't want anyone to fail, but I mean, people make bad decisions, and that's how we learn. So like going forward in the future, if the airlines realize, well, we kind of put ourselves in this situation because we bought too much of our stock back and we increased our dividends too much. Well, guess what? In the future, we're not doing that because we don't know if this happens again. So that's how you fix the problem, is you learn from your mistakes. So, and then you address those problems going forward. And that's the whole point of failing is learning from your mistakes. failing and then saying, hey, government, give me money. You're not learning from your mistakes. You're not improving your business model. You're not enhancing your overall. Same thing with the banks. So we're not learning anything as a society by just asking the government for money every time there's a crisis, whether it's a natural disaster or a self-inflicted wound, or a terrorist type of a threat. And I made that argument also, is that when you looked at 9/11, the airlines didn't get a bailout during 9/11. So I think something like 15 airlines went bankrupt. They went Chapter 11 and Chapter 7 after 9/11, and they didn't request money from the government, and we didn't do bailouts back then. So all those airlines after 9/11, because no one wanted to fly because they were afraid that their plane was going to become a weapon, they were in trouble. So they weren't making money. So what did? They filed for bankruptcy, Chapter 11, Chapter 7 bankruptcy. The other big airlines bought those smaller airlines, some of them did at least, to then expand their business and made their business more profitable. And that's what happens during a free market. So you didn't have that bailout. Well, after coronavirus, how many airlines filed for Chapter 7 and Chapter 11 bankruptcy? 0. So why was it okay for them to go under after 9/11, but then coronavirus, it wasn't the plane, it wasn't the airline's fault that terrorists flew planes into buildings around the world, but they had to suffer the consequences. And that's, it sucked. I'm a New Yorker, and I'm not saying it was good, but I mean, that was the reality. Was there was an incident, and companies had to, because it was unheard of in 2000 for the government to just dole out money to companies. The whole government giving people money or companies money started in 2008. So like if there was ever an incident or a crisis, before 2008 was that we had to deal with it as a society. It wasn't until 2008 where the government decided that we're going to use American taxpayer dollars and give people money. So it's really just a new phenomenon. So that was the other thing, is people were wondering, like, why is the stock market going up when we're in this great recession? The economy shut down and it's going up and up and up. And that was because we interfered in the market. So we had this sharp decline, and we had this massive rally in the stock market because of government intervention to supply money in the system. When you look at recessions in 2008 and in 2000, I mean, those things, the decline lasted 2 years, right? So, and this decline in the market only lasted 30 days. So it's completely different than anything else in history when comparing it.
Yeah, and it's we're at a point too. The problem with inflationary money is it disincentivizes saving, because if you put your cash in the bank, it's not going to gain any interest, and it's just going to perpetually lose its value and purchasing power. If we had hard money, like a gold standard, for example, people would be incentivized to save, and we wouldn't have to go into all these crazy Ponzi schemes in the stock market. I mean, you could, but it would be more of a challenge for companies to produce value rather than just manipulate their stock prices.
Well, the thing is, you don't necessarily need, I mean, hard money, it works, right? We know it works because we used to do it. But you don't necessarily need hard money. You need the market to dictate, because hard money, you still have interest rates. So, it's just the amount of gold that was backed by the currency. But before 1971, when we went off the gold standard, I mean, you still had interest rates rise on the dollar, go up and down while we were on the gold standard. So, trying to figure out when we went off the gold standard was, well, what rate does the free market want? And we found out, which was pretty painful in the 80s. But then you had the interference from the 1980s, where the rates just kept on going lower and lower and lower until now we're at zero. And the Fed's like, we're just going to keep them there. Is now it's disrupting the free market, finding out what the right price is on the dollar. And that's the point of keeping the interest rate so low, is you don't really know what the true value is if there's no interest rate. So, I mean, you don't need to go on a gold standard, but you just need the rates to be dictated by the market. So like, if there's a lot of housing demand, rates would rise. So that would make it more expensive for you to buy that house, which would then suppress the demand. But then if more people wanted to buy a home, or I'm sorry, if no one wants to buy a home, the interest rates would then get lower just by on free market, which would then spur demand. So basically just letting free market work and letting supply and demand work its way out, so that you know what the true value is on a dollar. But then when the Fed says that the interest rates are staying at zero, you're not letting that free market dictate what the true value is. And then that affects people with savings account because they get screwed by not getting any type of interest because the loans are made through banks. A lot of people don't understand, like, why are the banks not paying an interest rate? Well, the whole point of an interest rate is that the banks are supposed to take your money that you're saving, and then they create loans, whether it be like a car loan, a housing loan, loan, whatever. And they're giving it to someone who doesn't have the money, and they collect an interest. And because they're using your money to do that, you then get a kickback of whatever that interest rate is. But with the interest rates at zero, all the banks are borrowing at zero, and therefore are making loans near 0%. So therefore, your money in your bank gives you 0%.
Yeah, that's a really good explanation of it. I'm sitting over here. I think it'd be a good time to talk about Bitcoin a little bit because I'm sitting here watching the chart just go up right now. It's
okay. What do we got?
We're sitting at 11,700. So up a good. Let me pull up the percentage gain today. We are up about 5% today. So Peter Schiff will probably be tweeting about it going to zero somewhere. But so yeah, Bitcoin I think is a really interesting experiment because in some ways it is a opt out of the current financial system of government monopoly over money. Gold is proven over a long period of time to retain its value, much longer than Bitcoin's short existence. But Bitcoin has some different characteristics than gold. It's easy to send to places fairly quickly and inexpensively. Like I could walk around with $1 million of Bitcoin in my pocket or on my phone, whereas I can't do that with gold. So there's some definite advantages.
Right. So when I look at Bitcoin, I just look at it as another way of a medium of exchange versus I look at gold as an asset. So Bitcoin is a way for you to possibly pay someone else money. So if you want to purchase food, you could use dollars or Bitcoin. Versus gold, you could do that with gold too. Like I can hand you physically over a gold, ounce of gold coin, but you're not carrying around all of your gold. You're using dollars and or Bitcoin or other cryptocurrencies as a medium of exchange for goods. Now the thing is, when I look at cryptocurrencies, and people are like, well, the argument of gold or metals in general versus cryptocurrencies is, well, what are cryptocurrencies made out of? They're made out of semiconductors. They're made out of data centers. They're made out of energy, electricity. You need phones. So basically, you need all of these devices. And a lot of the devices, because you're mining Bitcoin, or a lot of people who mine Bitcoin is a source of energy. Metals is one of the main pieces of equipment that you need to mine cryptocurrencies, because you need electricity. So they're using copper, they're using silver, because all that stuff is built in through electricity. So if anything, without the metals, Bitcoin would actually be worth zero, because you need those metals for the entire system to function. Even if you put in metals and you create the circuit boards, You're using electricity to charge up so that you can use it on your iPhone. So you need metals, which create the product for you to use Bitcoin as a medium of exchange to get that good or services that you're using it. So, like I said, I still would look at Bitcoin as just something of a medium of exchange. Now, obviously, people trade it, buy and sell it every day, so the price of it goes up and down, just like any other financial asset. And I also look at gold or silver a little bit too, as an asset, just like my house is an asset, where, unless I stop paying for my house, that house asset is my own. Now, my house is, say, worth X amount of dollars. Price of housing goes up and down, but it's not. I don't have the physical cash, right? So if you own your house, I don't have in my bank account like, oh, here's X amount of dollars that my house is worth. I just know the value of the home. That's kind of like the same thing with gold. It's like I don't really need gold right now, but I have it because I want an asset. Like my house is an asset. So, and I know that with the dollar depreciating, that asset will be more valuable. And then if I need to cash in the future for a medium exchange, I can always sell it for cash in the future. Same thing with Bitcoin or cryptocurrencies. But I think that's what people kind of get the misconception of, is it's still just a medium exchange, and you have to have all these things with cryptocurrencies to function, just like you need with the digital dollar, right? So I can send people through Apple Pay. I can send you 50 American dollars through Apple Pay. But I can't send you those 50 digital American dollars through text or through Venmo if I didn't have what I mentioned, like electricity, a battery, right? So your iPhone runs lithium. So without the lithium that's in the battery and charge, I can't give you Bitcoin because it's all through electronics. And through the internet connection. So I need all of these products to make Bitcoin work, versus gold it will always be just that 1 ounce of gold. So, and that's kind of how I look at it. So that's why I'm not really big into cryptocurrencies. I understand it. I love technology. I'm not sure how really it'll play out in the future. I have a couple of different theses and scenarios. But that's how I just generally look at it. But since it's traded and people buy it and sell it, you have the price of it going up and down. But if you take away, like I said, all those pieces that make Bitcoin, the true value of Bitcoin would be zero then.
Yeah.
Does that make sense?
Yeah, that makes sense. Gold will always have utility. But there's a lot of people out there that would argue that you can use Bitcoin even without the internet. But if the internet were to fail, most people would not use it as a medium of exchange or be even able to. Yeah. Yeah,
and I'm not saying like doomsday where the complete blackout and something on that scale. I'm just saying that without all the things that actually how you can use and make Bitcoin, you need actual physical things to get your Bitcoin, right? So it's basically, so all Bitcoin is made up of all the things like electricity, energy, software. So it takes all of these components to create one Bitcoin, and it has a lot of and based on what it takes to create one Bitcoin. So you have the software guys, you have the energy, you have the battery, you have the internet connector, or the wireless provider. So all of this is basically taking into the price of one Bitcoin, right? So same thing with gold. If I don't have any gold, I have to mine it. So that means I need to buy equipment. I need to dig in the ground. So all of these components, and then that's why gold has a value. Besides that, it can be used for things, but I have to physically do something, and then I need tools because I can use my hands, but my hands are only going to get me so much. So if I buy a tractor, which then someone makes, that I can dig more for gold, I can get more gold. It saves me time. So once again, it's like all of these things, and that's kind of why we have a medium exchange, is because it's about how much value. If you produce more, then you're going to be more well off. And that's kind of like the point of capitalism. If you produce more, you have more excess wealth. And that's what happens, and that's why I'm in this business. People don't understand what wealth is. Wealth is an excess of your productivity. So if you make $100,000 a year, and you only spend 80,000, you pocketed 20,000. So that means that your wealth for the years is an extra 20,000. Well, if the Federal Reserve is saying, well, we're going to inflate away those $20,000 by 2%, 3%, 4% a year, how it doesn't make sense to own dollars, because why would my wealth currently being stored in dollars at 20,000 lose or go down 2% every single year when that's supposed to be wealth? Wealth is supposed to be something that appreciates over time. So that's why you have this issue that if you have interest rates at 2%, well, then I'll keep my 20,000 in dollars because now I'm collecting 2% and inflation's 2%. So now I'm maintaining my purchasing power. But when you're telling me rates are at 0 and inflation is going to be 3 or 4%, I need to get out of dollars and I need to go somewhere, whether currently that's Bitcoin, gold, or Tesla, or Apple stock. But I'm going to get out of dollars to fight that inflation, because my 20,000 is my wealth, and now I have to preserve that wealth. And I think that's what a lot of people don't realize, what's causing everything that's happened this year, and even beforehand.
Yeah, I liked your explanation of capitalism. And I think we're seeing such a big emphasis on socialism because what people know is that there is they're producing value and they're not getting returns on it. And there's kind of a disparaging, a growing wealth gap as that wealth is getting confiscated by inflation. This is probably the third time I've talked about it, but true capitalism is producing value and trading voluntarily. And when there's coercion, when there's price fixing and all these things like minimum wage, it interferes with that and actually leads to less good for the society. Now, things like Bitcoin or a car or so like a difference between like a Porsche and a Ford Fiesta, which is a piece of crap. The Porsche has more value because it is harder to make. And so gold has value more so than precious metals, one, because of the scarcity, but also the difficulty to extract it. And that's a guarantee. Bitcoin, is very, very difficult to make. It has a fixed supply. There is a difficulty adjustment. So if you can't mine it quicker or slower, or you can for very short amounts of time, but the difficulty adjustment happens every 2 weeks. So the more power and energy that goes into it, you get the same amount of Bitcoin, which is a really interesting and unique characteristic of it that almost guarantees its value as long as people are, really competing for it, and they are. But yeah, those ideas of scarcity and difficulty to produce are really, really important to get. Now, it's getting more and more easy for the government to, print money. And most of what they're doing is just digital, changing zeros in bank accounts. The Fed doesn't issue cash. A lot of it, they just, will reach out to JP Morgan and say, you now have X amount of money and you owe us X amount, interest on it. What do you think is the long-term play for fiat money? Like where are we going?
Yeah, I guess this could be a good way to kind of sum everything up, right?
Yeah.
Well, I think the near term, if you look at, I just put out today through social media that South Korea is officially going universal basic income. Canada is looking at it. Universal basic income, UBI, has already been talked about with Andrew Yang here in the United States. The $600 extra week stimulus for unemployed in the first CARES Act, which ended up being like an additional $2,400. Could have been like a test run on universal basic income. They're talking about giving out in the next stimulus package, whether it's with Trump or after re-election or after the election, an additional $1,200 stimulus checks and like $1,000 per child per family. So basically, what I'm trying to say is the universal basic income is here because everyone's in debt, and you need people basically to continue to spend. You need to basically provide them, or the government is trying to provide them to kind of keep the whole system going. And they looked at what Japan and Europe and Sweden has done with negative interest rates. And the thing is with negative interest rates is it only works, or the theory behind negative interest rates is that you wouldn't want to be in your currency because it's like inflation except accelerated basically. But it only works is if people are taking out loans so that they're buying financial assets where the assets are appreciating in value. But the thing is, like a house like that, well, if you plan on living in a house for a while, it's going to take you a while to get to be the beneficiary of the negative interest rate. So if you buy a house for $500,000, and because it goes to $1 million, but that could take like 10 years with negative interest rates to happen. So that's why if you look at like the ECB in Japan, they're like, we've been doing negative interest rates and we haven't had like any these issues, or it's not working, which we thought would have this inflation effect. Well, that's because like, why would I sell my house? Because I still need to live somewhere. So if it's a financial asset, it doesn't really help, and you still have poverty or low income, middle income, so it doesn't really help them. So all these U.S. stimulus, different types of programs that they're talking about is like a form of UBI. Other countries are talking UBI, and that's a way of getting money directly to everybody, even though the wealthy may not need it, but the people who aren't in high or middle income brackets, getting money directly for them so that they can go spend in mom and pop's pizzeria and coffee store. Go buy the new iPhone and help the bigger corporations, or so giving people money directly will actually get the inflation that they're wanting, because you're giving people money to go spend versus like this financial trickery of negative interest rates, but no one really understands it. So it didn't really play out to the way that they thought it would play out. And maybe if they marketed it better, saying, well, if you buy a house and you borrow $500,000, you only have to pay back $400,000. Maybe you would have people buying houses because they have to pay people back less money. But that really hasn't happened. I don't see that happening. So that's why I think the next stage, because I call it the Great Fiat Ponzi scheme. So I think the next part of this scheme is actually going to be UBI, which will get the inflation that they're looking for. And basically we're now on the lines of what they call as modern monetary theory, or MMT, where basically the government just prints whatever amount of money, which with 27 trillion in federal debt, not including unfundable liabilities, is basically we're there already. But the money has basically stayed in financial assets and not really trickled down into the general population, which I think why there's a universal basic income movement, because people are so fed up with the bailouts from starting with 2008. And they're like, we keep on printing billions and trillions of dollars, but yet, the low and middle class Americans are getting screwed. But eventually we're going to find out that UBI is not a utopia type world. It may start out like it, but once business owners realize how much more they can charge more, that's when you can have that inflation pick up. So you'll have like these UBI programs. At first it'll be euphoric, be very utopian-like. Everyone thinks it's great. And then like iPhones this year are $1,000. The next year iPhones are $2,000. The following year iPhones are $3,000. And people are like, what the hell just happened? And same thing with food. Every week or every month we're spending $300 in food. Now we're spending $600 in food. Then $900. So it just slowly starts to creep up until basically the supply and demand is then rebalanced, and then the purchasing power of whatever amount of UBI is by the amount that it buys us to that, because we're not making any more goods. So that's how I see, and then that's when inflation will really get going, and then talks of how are we going to control inflation, and then the way to control the inflation would be then to remove the UBI, because now you're taking money out of the system. So now people have less money. So that means they can't spend on goods and services. or through taxation, raise taxes. So in Stephanie Kelton's book called The Deficit Myth, she basically says that you can print all this money that you want in the world, and then that if this inflation scenario that I'm talking about plays out, well, instead of paying 20% taxes, we're going to make taxes 50%. So maybe we'll keep UBI, but we're going to tax you more money out of your paycheck. So basically, it's just a way for them to take more money out of you. You know, once again, they're getting involved in the free market because it'll be good at first. Everyone thinks it'll be great getting $1,000 extra a month. Then a year or two goes by, and then they realize that $1,000 just buys them the same as before they had $1,000. Then maybe the outcry will be, we need $2,000 a month. And then the cry for UBI price will go higher and higher and higher, because they'll say, well, $1,000 was such a great success, why not make it $2,000 now? And then so forth and so forth. And then you get that inflation, then they say, well, hold it now, let's remove it, or we'll raise taxes, and you'll still get UBI, but we're going to take more money out. You know, it's just all a facade, and you know, people want government involved, and we just don't want to go through the process of letting the free market kind of just working its way, because it takes a while. It could take a year, it could take 2 years, and you know, everyone wants something done now, and that's why we're seeing what we're seeing today. That's kind of like where I see where we're going with UBI though in the markets.
Yeah. So pretty much what I hear is UBI will be good business for you, because there'll be more of a demand for people to need help with their wealth being protected.
Absolutely.
Yeah. Well, thanks for that explanation. Yeah. I mean, it's growing ever more clear that the end game for fiat currencies is just zero. And that's why it's so good to buy gold and assets that are scarce, you know, real estate, Bitcoin, my favorite. Where can people find your work? I know you have a pretty cool podcast you have going.
Cool. So, yeah, I'm on YouTube for Golden Coast Consultants. I'm also on all social media platforms, and on Twitter handle you can find me at Greg Crennan. And if you guys have questions on how to either start or change or just want to have a free consultation with me, for any of your listeners, I do wealth management for individuals. So each individual is different based on what they're trying to solve for. So I basically create individual wealth plans for people. If you believe in what I'm basically saying is happening, can get everyone on the right path and protect their wealth going forward from out of control central banks.
Yep. Those crazy central banks. Jay Powell and his moneypreneur. Yeah. I found you on Twitter because I'm pretty sure Fed Up tagged you in a post to troll me on gold. And really enjoy your work. And you definitely have an awesome podcast on YouTube.
Anyone who's interested, I have some fun, some material for people to go over. I kind of, my annual client letter that I issued out this year is on LinkedIn. It's also pinned on my Twitter handle. So kind of it's like a little bit longer of an explanation into what the fiat scheme is and how we got here today. So a little bit more in depth based on our conversation we had today.
Awesome. Well, thanks for doing the interview.
Absolutely. Thanks for having me. And maybe after the election, we can see what's going on with the markets then.
Yeah. I really enjoyed that interview a lot. Greg's a really smart guy, and he's been pretty helpful just having discussions with people and myself on Twitter. He's pretty reachable on LinkedIn if you are interested in pursuing him as a financial advisor. One of the things that he said as far as having an edge on some of the bigger wealth management firms is that when you go with a financial advisor like him, you're not gonna get destroyed by fees in the same way that you would with the bigger firms. And these are fees that you generally don't really notice when you're meeting with the advisor. But yeah, if you like what I'm doing with the podcast, I'd love if you would support me. And some of the best ways to support me is liking, subscribing, leaving a review. But yeah, if you want to go to the next level of support, I just launched a Patreon page, and you can become a patron. and there's some cool things that you can check out on there. But anyways, thanks for stopping by the podcast.